In November 2021, Nike's stock closed above $177 a share. By August 17, 2026, it had closed at about $39. That's a decline of roughly 78%, the lowest close in about 12 years. And this isn't a small brand getting crushed by a bigger one. This is Nike, the company that taught the entire sportswear industry how to build a global brand. The strange part is that Nike isn't failing. It still generates more than $46 billion a year in revenue. It's still profitable. It still owns one of the most recognizable symbols on the planet. But somewhere along the way, something changed. Consumers discovered running shoes from Hoka and On. Adidas found new life. Nike weakened relationships with retailers that had helped build its empire. Digital sales started falling, and some of its most famous sneakers became so common that the exclusivity that made them desirable began to fade. So the market isn't asking whether Nike survives. It's asking a harsher question. Has Nike lost the thing that made it special? And if it has, can it get that back? Nike's story starts with two people who split the work perfectly. In 1964, Phil Knight and his former University of Oregon track coach Bill Bowerman started importing Japanese running shoes and selling them to American runners. Bowerman obsessed over the product. Knight understood distribution and marketing, and together they built something much larger than a shoe company, because Nike figured out how to attach meaning to a piece of rubber and fabric. It didn't sell cushioning, it sold achievement, competition, identity. The Air Jordan era pushed that further, until the athlete, the product, and the story became almost inseparable, and that produced Nike's real advantage. One person might buy Nike to run faster, another might buy the exact same shoe because it looked good with jeans. Performance plus culture. That combination was extraordinarily difficult for competitors to reproduce. Behind it sat a business model built for leverage. Nike designs, develops, and markets its products, but most manufacturing is handled by independent contractors. That freed Nike to spend its money on product development, athletes, and brand building rather than on factories. The raw materials in a sneaker have value. The swoosh makes the finished product worth considerably more. Add technology, add an athlete, add limited availability, add a story. Suddenly, Nike isn't selling footwear, it's selling perceived value. And Nike had one more advantage that was easy to overlook: shelf space. Walk into a Foot Locker, a Dick's, a specialty running store, Nike was hard to miss. That mattered more than it looked like it did. Someone shopping for running shoes might not have walked in intending to buy Nike, but once Nike was on the wall in front of them, Nike had a chance. Retail partners handed Nike access to consumers who weren't Nike customers yet. And then Nike became convinced it could improve on that by cutting out more of the middleman. The logic behind direct-to-consumer was genuinely good. Say Nike sells a $150 shoe through another retailer. That retailer takes part of the economics. But if Nike sells that same shoe on Nike.com or the sneakers app or in a Nike store, Nike captures more of the selling price and owns the relationship. Nike gets the transaction, Nike gets the data. Nike knows what you bought, what size you wear, what you browsed, and when to bring you back. This wasn't a sudden idea. In 2017, Nike laid out its consumer direct offense and a plan it called the triple-double. One of the goals was 2x direct, doubling Nike's direct connections with consumers. The company projected digital would grow from roughly 15% of revenue in fiscal 2018 to more than 30%. Then COVID arrived. Stores shut down, e-commerce exploded, and Nike's strategy looked almost prophetic. So Nike pressed the accelerator. More membership, more apps, more Nike-owned retail, less reliance on parts of the traditional wholesale network. From the inside, the logic must have felt irresistible. More control, more data, better economics. There was one problem. The pandemic changed shopping. It didn't eliminate stores, and Nike was about to find out that the middleman had been doing something far more valuable than taking a cut. Retailers don't just sell product, they provide reach. Think about the difference between someone opening the Nike app and someone walking into a multi-brand running store. The person opening the Nike app has already chosen Nike. The person walking into the running store hasn't. That second customer might compare 6 brands, and if Nike isn't on the shelf or doesn't have enough of the right product on the shelf, somebody else gets that customer. Hoka, On, New Balance, Brooks, Adidas. Nike didn't create those competitors, but pulling back from wholesale gave them room to build relationships Nike used to own. And nowhere was that more dangerous than running. Running isn't a side business Nike stumbled into. Bill Bowerman was a track coach. The company was built around runners. So when consumers started getting genuinely excited about Hoka and On, Nike wasn't just losing transactions, it was being challenged on its home field. Meanwhile, a second problem was building. Nike had enormously successful lifestyle franchises: Air Force One, Dunk, Retro Jordan. The trouble with a shoe that sells is that the temptation is to keep selling it, and selling it, and selling it, until a product that once felt special starts feeling ordinary. Nike eventually began deliberately restricting supply of some of those classics to clean up the marketplace and make room for newer product, which means accepting real revenue damage today in exchange for demand that may return later. And that's a big part of why this turnaround has been so slow. Nike isn't simply trying to sell more shoes, it's intentionally selling fewer of the shoes that used to print money, betting that new ones will replace them. But even that isn't Nike's hardest problem, because thousands of miles away, the growth engine has been running in reverse. When Nike laid out that 2017 growth plan, Greater China was expected to grow at a low to mid-teens rate for the following 5 years. There were good reasons to believe it. Hundreds of millions of increasingly affluent consumers, rapidly expanding sports participation, real enthusiasm for global brands. That story has fallen apart. Greater China revenue came in at $5.85 billion in fiscal 2026, down 11% as reported, 13% currency neutral. 2 years earlier, that number was $7.5 billion. Digital sales in the region fell 29%. Footwear unit sales fell 14%, which matters because that's not a currency problem or a pricing problem. That's fewer pairs being sold, not just a currency or pricing effect. And the region has now posted 8 consecutive quarters of declining sales. Chinese consumers have become more selective. Local brands like Anta and Li Ning became genuinely credible. Hoka and On are fighting for the same attention. And Nike's own marketplace in China got messy. Too much discounting, too many sellers, the same product at different prices across different channels. That is poison for a premium brand. Because if customers get used to seeing a $150 Nike shoe discounted to $110, eventually $110 becomes the real price. So Nike is taking a drastic step. Beginning in January 2027, key Chinese retail partners will stop selling Nike products through their own online storefronts. Nike will concentrate digital sales through official Nike storefronts on Tmall, JD.com, and Douyin, alongside its own site and app. The stated goal is control, cleaner pricing, less discounting, a more consistent premium experience. Sound familiar? It should. Nike spent the last several years learning a painful lesson about pulling away from distribution partners in North America. Now it's restricting third-party online distribution in China. There's a real difference. Nike isn't abandoning physical retail partners there, and the company argues China's fragmented digital marketplace is a different animal. But some analysts aren't buying it. One estimate reported by Reuters put the cost of the move at $500 million to $1 billion in sales, and argued Nike's China problem was never distribution, it's product. And that gets to the center of everything. China isn't a distribution problem. It isn't an economics problem. It isn't a discounting problem. Nike has to convince Chinese consumers that its products are exciting again. Nike has responded by putting leadership in place focused on creating products specifically for that market, but that takes years, which is a problem because Wall Street is running out of patience. In 2024, Nike decided it needed a reset. John Donahoe stepped down as CEO, and Nike called back somebody who knew the place from the inside, Elliott Hill. Hill had spent more than 3 decades at Nike across sales, geography, and commercial operations before retiring in 2020. He came back with a simple message: Nike needed to get back to sport. Under Hill, the company launched what it calls its Win Now actions and reorganized around a broader sport offense: running, basketball, football, training. Athlete-centered innovation, better storytelling, a healthier marketplace, and rebuilt wholesale relationships. Here's where the numbers get interesting. Fiscal 2026, Nike brand wholesale revenue rose 6% to $27.5 billion. Nike Direct went the other way, down 6% to $17.7 billion. Nike brand digital fell 12%. Think about how complete that reversal is. A few years ago, investors were told direct digital relationships were Nike's future. Today, wholesale is the strongest part of the turnaround. Nike hasn't abandoned direct-to-consumer, and it shouldn't. The lesson is subtler than that. Nike needed both. The app matters, Nike stores matter, but Foot Locker matters, Dick's matters, specialty running stores matter. The consumer doesn't care about Nike's channel strategy. They want the right shoe in the place they already shop. This is where I think the story gets genuinely hard to call, because the bull case is stronger than the stock price suggests. Nike generated $46.4 billion in fiscal 2026, flat year over year. After a fiscal 2025 in which revenue fell sharply while management deliberately burned down old lifestyle inventory, flat is not nothing. North America grew, wholesale grew, gross margin ticked up to 42.9%, inventory held flat at $7.5 billion. Nike stayed profitable, returned about $2.5 billion to shareholders, and raised its dividend for the 24th consecutive year. That is not the balance sheet of a company in trouble. That's a company absorbing a self-inflicted reset and still generating cash. And Nike frames fiscal 2026 exactly that way, a year of repositioning, stabilizing, and rebuilding brand momentum. So why won't the stock cooperate? Because when you look underneath the headline numbers, the skeptics have the better evidence. Start with the fourth quarter, which looked like a genuine beat. Gross margin jumped 890 basis points to 49.2%, but roughly 900 of those basis points came from a one-time tariff recovery benefit. Excluding it, gross margin was actually about 10 basis points lower than a year earlier. So the spectacular headline margin wasn't evidence of a spectacular operational improvement, and the underlying trends keep pointing the same direction. Direct sales are still falling, digital traffic is still weak, Greater China is still deteriorating. Converse revenue dropped 31%. Even Jordan Brand, one of the strongest franchises in the history of consumer products, generated about $7.0 billion in fiscal 2026, down from roughly $8.7 billion 2 years earlier. And here's the detail that I think captures the whole situation. Nike's stock has fallen 78%, but that doesn't automatically make it cheap. As of mid-August 2026, Nike still traded at roughly 23 to 24 times forward earnings. Deckers, the parent company of Hoka, traded at roughly half that multiple while still growing. And the profitability gap is striking. Deckers' trailing net margin is around 18%. Nike's fiscal 2026 net margin was 6.7%. Nike is vastly larger, but right now Deckers turns a much greater share of every sales dollar into profit. That's the gap. Nike is still the biggest brand in the industry. It is no longer the most profitable one per dollar of sales. That's really the central issue. Nike's advantage was never scale, it was heat. Nike could release a shoe and make people care. It could sign an athlete and turn a contract into culture. It could take performance technology and make ordinary people want to wear it to dinner. But brand heat is almost impossible to see on an income statement until it's already leaving. A weakening brand still generates billions for years. Existing customers keep buying. Old franchises keep selling. Retailers keep ordering. The logo stays famous. Underneath all of it, competitors slowly become more interesting, which is why Hoka and On matter more than their size suggests. Neither has to beat Nike. They just have to keep winning individual customers. A runner buys Hoka once, likes it, buys another pair, tells a friend. Nike hasn't lost one transaction, it's lost a relationship. And that can happen slowly enough that a company this large barely registers it. Now, to be fair to Nike, it has been shipping. In 2025, the company simplified its road running lineup around 3 core franchises, Pegasus, Structure, and Vomero, with a broader Icon, Plus, and Premium tiering strategy. The Vomero 18 became a $100 million business within roughly 90 days of launch. Nike's running division grew more than 20% in the first quarter of fiscal 2026. That's real. That's the strategy working. But look closely at what else happened. The Pegasus Premium was Nike's first shoe with a sculpted, visible air zoom unit in a running silhouette, a serious piece of engineering. Reviews of it as a pure running shoe were mixed, with weight among the criticisms. But its appearance also generated substantial attention, which is either a triumph or the entire problem, depending on how you read it. Because that's Nike's whole formula in miniature, performance plus culture. Except this time, the culture part may be carrying more of the load than Nike would like. There's one reason I'd never count Nike out. Very few turnarounds start with assets this good. The swoosh still matters, Nike still does $46 billion a year, Jordan is still a multi-billion-dollar franchise, Nike still has relationships with elite athletes almost everywhere sport is played, and management appears to genuinely understand that the company drifted from what made it work. But understanding a problem isn't the same as solving one, and every year the fix takes is another year Hoka wins runners, another year On gains shelf space, another year Anta and Li Ning get stronger in China. Investors aren't asking whether Nike survives. Obviously Nike survives. They're asking whether Nike can be a growth company again. That's a much harder question. Because Nike's biggest problem may not be that consumers stopped liking Nike, it's that consumers now have alternatives they genuinely like. For decades, Nike was the company everyone else was chasing. Today, Nike is doing some of the chasing. And that may be the real lesson here. Dominance is dangerous. When products are selling and the stock is climbing, almost every strategic decision looks brilliant. Business strategy is rarely a choice between something obviously smart and something obviously stupid. More often, it's knowing when a smart strategy has gone too far. Nike's turnaround is an attempt to find that line again, between digital and wholesale, performance and lifestyle, scarcity and scale. Fiscal 2026 suggests Nike has finally stopped moving backward quite so fast. But the market is sending an unmistakable message. Stopping the decline isn't the same thing as winning. Nike spent decades telling athletes that past victories don't count once the next race starts. Now the company has to prove it believes that about itself.